The Treasury Department took nearly unprecedented steps today to try to reassure a corner of Wall Street that nobody paid much attention to even just a few weeks ago, the money market fund industry. It's a $3.4 trillion industry, and most American households have come to think of money market funds as being just as safe as a bank account, even though they had previously not been insured or guaranteed in any way. That's the big step the Treasury took today. They announced a new plan, a temporary one. For 1 year, they will knit together a sort of FDIC insurance program for money market funds. This will reassure people that their assets are safe and calm any jitters that may have remained in the market after one of the most turbulent weeks the money fund industry has ever seen. It started on Monday with the stock markets in turmoil and the credit markets equally uneasy over the bankruptcy of Lehman Brothers. As it turned out, by letting Lehman Brothers fail, the federal government pushed some of Lehman's credit securities into default. And a large money market fund held a big slug of Lehman's paper. It announced on Tuesday that because it had written down the value of those assets from Lehman Brothers, it would no longer be able to sustain the $1 per share price that is the bedrock of money market funds. Consumers have long assumed, although regulators and industry experts are careful to say, they can default, but they've always assumed that a money market fund would never break the buck, that your share price would always stay $1 and you'd get $1 back for every dollar you put in. Well, money market funds are an important tool not just for you and me, for households, but for big institutional investors as well. Corporate treasurers, pension funds, hedge funds, when they need to park their cash, they use money market funds too. They use institutional money market funds, and it's that sector of the money market fund business that panicked this week. Paradoxically, the small players, the retail investors, actually pumped $4 billion into money funds this week. They saw them as a safe haven. But the big guys were pulling money out at an unprecedented rate, destabilizing the market by forcing these money funds to sell assets in order to give people their cash back. To forestall that panic, the Treasury stepped in today with announcing two steps. First of all, the 1-year guarantee program. The details are still unclear, and we still need to see how it's going to work, but it certainly sounds reassuring. The second step, it comes from the Federal Reserve. The Federal Reserve announced that it would make special lending available for commercial banks so that they can buy any assets that a money fund has to suddenly sell. This will add liquidity to the marketplace, shore up the values of money fund assets, and reduce the risks that a money fund will drop under $1. But where do we go from here? That's really going to be the big question. The big guys panicked. If they calm down with these steps, then certainly it buys the regulators some time to figure out what the proper role of money market funds is and how they should be monitored and regulated. The lesson for the rest of us, of course, is the days when you could shop for yield among your money funds are over. Today, you want to shop for safety. You want to be sure you know what kind of risks your money market fund is taking and whether you're comfortable with those risks. So as we go forward, watch for yields to come down, watch for consumers to get pickier, to look for safe havens at the big companies, and to watch smaller money market funds really try to prove themselves to consumers as the safe havens we've always thought that they would be.